You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Okay, let's unpack this. Have you ever felt sort of stuck in that cycle? Working harder and harder, but the finish line just seems to keep moving.
Yeah?
Like you're just trading your precious time for money, but not actually building anything that lasts.
It's incredibly common, that feeling.
Yeah.
And for so many people, they look around and see others who, well, seemingly starting from the same place, somehow build real financial security, maybe even wealth, while they're still just scraping by paycheck to paycheck.
Right. And the sources we're looking at today really dig into why that happens. They argue it's less about luck or even how smart you are, and much more about a fundamental shift in how you think.
Exactly. We're talking about the difference between thinking like a worker and thinking like a wealth builder.
Yeah.
And our mission here in this deep dive is really to pull out the core insights from this material. What are the, essential differences in these mindsets? What are the practical strategies for making that transition? And maybe most importantly, what does it actually look like in the real world for your future?
So if you've ever wondered if there's a different way, maybe a path to break free from that time for money treadmill and start building genuine financial independence, stick with us.
Yeah.
This deep dive might just give you the perspective and maybe some practical steps you've been looking for.
The source material kicks off with a story, actually, to highlight this core difference, this kind of great divide. And I think it's a pretty powerful way to see it right off the bat.
It really sets the stage, doesn't it? Okay, so imagine two people, Sarah and Mike. The source says they started their careers, 20 years ago, same company.
Similar backgrounds, probably similar starting salaries, the usual thing.
Right. But fast forward to today, Sarah, she's still at that same company, likely makes good money, maybe even six figures. Still living paycheck to paycheck, maybe has some nice things, sure, but that underlying financial stress, it's always there.
Always humming in the background. And Mike.
Well, the source says Mike retired 5 years ago.
Wow.
At 45. Financially independent, living off multiple income streams he built. Same starting blocks, completely different financial outcomes.
And according to the source material, the key difference wasn't some secret inheritance or just blind luck. It was mindset. Sarah thought like a worker. Mike thought like a wealth builder.
Okay, let's break down that worker mindset first, because honestly, this is where most of us start, isn't it?
Oh, absolutely. It's what the system often conditions us for. Get good grades, land a stable job, work really hard, try to save a bit.
Yeah.
And the source isn't saying those things are inherently bad. They provide stability, a foundation.
Yeah.
But the key insight is that this approach is fundamentally limited for creating real wealth.
Why limited?
Because workers tend to think in terms of linear income.
Linear income. Okay, so you mean like you're literally trading 1 hour of your time for X amount of dollars. There's a direct cap based on your time and energy.
Precisely. Your income is directly, tightly tied to your personal time and effort. If you want to make more money, you have to work more hours or get a promotion for a higher hourly rate or find a higher paying job altogether.
And the moment you stop working,
the money stops.
Right.
There's no built-in momentum carrying you forward.
And the source also points out they prioritize security over opportunity. That steady paycheck, the predictable path that feels safe.
Yes, and that often leads to seeing risk as purely dangerous. Something to be avoided at all costs.
Even calculated risks.
Often, yes. Avoiding risk becomes the main goal, which paradoxically means missing out on opportunities that could lead to significant financial growth or freedom down the road. They value that perceived safety today over potential freedom tomorrow.
And instead of viewing money as like a tool for growth, the source says workers often think more like consumers.
Right. Their main focus tends to be on managing expenses, creating budgets, maybe trying to save some money. They see money primarily as something to be earned, then preserved, and eventually spent.
Not multiplied.
Not actively multiplied or deployed to create more money. It's more about holding on to it than growing it.
Okay, so that's the worker frame. How does the wealth builder flip that script? How does Mike manage to retire at 45?
Well, wealth builders see the whole game completely differently. They fundamentally understand that real lasting wealth isn't just built by trading your hours for dollars.
Right.
It's built by intelligently deploying capital, creating systems, and harnessing growth that isn't dependent on their personal day-to-day labor.
So instead of that linear income, They're thinking scalable income.
Exactly. They're constantly on the lookout for ways to generate money that isn't directly tied to their time. That could be building businesses that can eventually run without them being there every minute.
Or investing in assets that pay them.
Or creating systems, maybe using technology that generate income, whether they're actively working, sleeping, or on vacation.
And instead of avoiding risk, they see opportunity in risk.
Yeah, they understand that significant returns, the kind that really move the needle, often require taking calculated risks. Not reckless gambling, but informed risk-taking.
So they're willing to lean into uncertainty sometimes. Maybe sacrifice a bit of short-term comfort or that feeling of security.
For the potential of building substantial long-term wealth, absolutely. They analyze risk, they manage it, but they don't run away from it entirely.
And the source is really clear here. Instead of thinking like consumers, they think like owners and investors.
That's the core shift. Their focus moves from managing spending to acquiring assets, things that actively put money into their pockets or build equity over time.
So money isn't just something to spend, it's a tool, a seed.
Exactly. A tool or a seed they can plant to grow more money, to build more assets.
What's fascinating here is how deep these mindsets run. The source suggests it's less about some innate talent and way more about conditioning, perspective. It's like rewriting your financial operating system.
Completely. And that leads us nicely into the fundamental principles that guide the wealth builder. What are the core rules they play by that the worker often misses?
The source points out several, but maybe the most crucial one, the absolute bedrock, is asset accumulation over income maximization.
This is such a key distinction. It's huge. Workers focus on getting that raise, boosting their paycheck, maximizing their income.
While a wealth builder focuses on acquiring assets.
Right, because like we said, income stops when you stop working. Assets, ideally, keep generating income or growing in value whether you're actively working or not.
Okay, define asset in this context, just so we're clear.
Good point. The source defines an asset here as anything that puts money in your pocket without requiring your active, ongoing labor. So think rental income from real estate.
Dividends from stocks.
Profits from a business you own but have systems and employees running. Royalties from creative work, interest from loans or bonds, that kind of thing.
This really connects to that cash flow quadrant idea the source mentions, right? Employees and the self-employed on one side trading time for money.
And on the other side, you have business owners and investors. They own the systems or the assets that generate income for them.
The contrast the source gives is really stark. You have a worker making, say, $100,000 a year. Their focus is laser sharp on getting that $10,000 raise to hit $110,000.
Which is great, but it's still linear. Now, compare that to a wealth builder also making $100,000. They might focus instead on taking a chunk of that income, maybe $50,000, and using it to acquire assets that generate, say, a 4% annual return.
So the worker gets a one-time income bump, maybe pays more in taxes on it. The wealth builder creates a new, potentially permanent income stream of $2,000 a year.
And that stream itself can grow over time, plus the underlying asset might appreciate. It's a totally different approach to increasing your financial well-being.
Okay, what's the next principle?
The next one is leverage and multiplication. Workers tend to think additively, add more hours, add a new skill, add a bit more savings. Wealth builders think multiplicatively, they use leverage.
Leverage, okay. The source breaks this down. First, financial leverage.
Right. This is basically using other people's money, OPM, to acquire assets. The classic example is using a mortgage to buy investment property.
So you put down maybe 20%, the bank puts up 80%.
Exactly. And if the rent you collect covers the mortgage payment, taxes, insurance, and other expenses, you're effectively building equity and possibly generating cash flow using mostly borrowed funds. That's leverage.
Then there's human leverage.
This is fundamental to business ownership. It's about building teams and systems so that other people's time, skills, and effort contribute to your income or wealth creation.
You're not doing all the work yourself.
No. You create a structure, a system, where the combined effort of your employees generates value and profit that flows back to you as the owner.
Technology leverage. This has to be massive today.
Oh, absolutely critical. Using technology to scale your efforts, often globally, reaching millions of potential customers with very little extra cost per customer.
Like creating software, an app, an online course.
Exactly. Do the creative work up front, maybe build the platform once, and technology allows you to sell it or deliver it over and over and over again. Massive multiplication potential.
And finally, knowledge leverage.
This is about turning your specialized knowledge, your expertise, into assets. Writing a book, creating educational materials, developing unique systems or processes, licensing your intellectual property.
So your knowledge itself becomes the base for creating value and income streams that aren't just limited by the hours you can personally bill out.
Correct. Principle number 3, the source highlights, is systems over services.
Okay, how's that different from leverage? It sounds related.
It's closely related, especially to human and tech leverage. But the focus here is the output. A worker primarily provides a service. They trade their direct time and skills for a fee. Think a freelance writer, a consultant working solo.
Whereas a wealth builder focuses on creating or owning systems.
Right. A system is a mechanism, a process, a structure that operates and generates value even when you, the owner, are not directly involved in every step.
Like the example of the freelance graphic designer versus the design agency owner.
Perfect example. The freelancer only makes money when they are actively designing.
Huh.
The agency owner has system salespeople finding clients, project managers coordinating work, other designers doing the execution. The agency generates income, even if the owner takes a week off.
So business ownership, done right, is really about building or acquiring these functioning systems.
Precisely. And that leads to the fourth principle, which feels almost magical sometimes, the compound growth mindset.
Ah, the eighth wonder of the world, right?
That's what Einstein supposedly called compound interest. Workers tend to think linearly, step by step. Wealth builders grasp and harness the exponential power of compound growth.
Earning returns on your returns, profits on your profits.
Growth building upon itself. The source uses that simple classic example. Invest $1,000. Let's say it earns a 10% annual return. After year 1, you have $1,100. Seems simple enough.
Just an extra $100.
But the next year, you earn 10% not just on the original $1,000, but on the $1,100. So you get $110 interest, bringing you to $1,210. That extra $10 from year 1 also earned interest.
And that small difference, it starts to snowball.
Massively. Over time, it becomes astronomical. That initial $1,000, after 20 years at 10%, grows to over $6,700. After 30 years, it's over $17,400.
Wow.
The growth isn't a straight line. It's a curve that gets steeper and steeper over time.
And wealth builders actively structure their entire approach around maximizing this effect.
Absolutely. They consistently reinvest profits and dividends. They understand the immense value of starting early to give compounding more time to work its magic. And crucially, they practice patience. They see wealth building not as a sprint, but as a marathon where consistency unlocks that exponential growth.
Okay, so understanding the mindset, grasping these principles, that's step one. But how do you actually do this? How do you make the shift? Here's where it gets really interesting. What are the practical strategies the source suggests?
Yeah, this is where the rubber meets the road. And the source is clear. You don't necessarily need to quit your job tomorrow. In fact, your current income, whatever it is often your starting capital.
Okay, strategy one. Start building assets while you work. This sounds fundamental.
It absolutely is. The action step here is pretty direct. Take a hard look at your current finances. The source prompts you to analyze. How much of your income can you realistically redirect away from just consumption and towards acquiring assets?
Even small amounts matter.
Definitely. The source mentions even a couple $100s a month, invested consistently, adds up significantly over the long haul.
And the key mechanism is paying yourself first.
Yes. Before the bills get paid, before the discretionary spending happens, you automatically allocate a set portion of your income, specifically for buying assets. Make it automatic if you can automatic transfers to an investment account, direct deposits into a separate savings account earmarked for a down payment. Take the decision out of it each month.
The source uses the example of Carlos, the teacher, not a super high earner, right?
Right. But he started investing just $300 a month, consistently. Put it into low-cost index funds starting at age 25.
And the result?
By age 65, assuming a pretty standard 7% average annual return, that consistent $300 a month grew to over $870,000.
Wow. Without needing huge risks or some crazy career change.
Just consistent action, directing income towards asset building, and letting compounding do its thing.
Okay, strategy two. Develop multiple income streams.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
This tackles that dependency issue. Workers often rely entirely on one income source, their main job, which is inherently riskier.
Yeah, if that job disappears.
Exactly. Wealth builders understand this vulnerability. They actively work to cultivate diverse sources of income.
So the action here is to look at yourself, your skills, your knowledge, maybe assets you already have, and identify ways to generate income outside your primary job.
Precisely. Could you do some consulting on the side? Teach a skill online? Rent out a spare room or your car? Create a digital product related to your expertise?
The goal isn't necessarily to replace your job income overnight, but to start diversifying. Reduce that reliance, create streams that maybe aren't capped by your time.
Right. And some of those streams might eventually grow to be quite significant. Think about Lisa, the accountant example from the source.
She started doing bookkeeping on weekends.
Using her existing skills, built up a client base. Eventually, that side income grew large enough, and she gained the confidence to leave her corporate job and launch her own accounting firm.
And then she hired other accountants.
Creating a business system, leveraging other people's time, generating income far beyond what she could earn just billing her own hours. That's multiple streams evolving into a business asset.
Strategy 3, invest in your financial education. This seems crucial.
Absolutely critical. Think about it. Traditional education and job training teach you how to be a good employee, how to do your specific job well.
But they don't usually teach you how to invest, how to think like a business owner, how tax strategies work for wealth builders.
Exactly. You need a different skill set. So the commitment here, the source suggests, is dedicating regular time, maybe just an hour a week, to start purely to learning about wealth building topics.
Read books, listen to deep dives like this one, take online courses, find mentors.
Whatever works for you. The key areas the source highlights are investment fundamentals, understanding stocks, bonds, real estate risk, return, diversification, all that.
Business and entrepreneurship, even if you don't plan to start a huge company, understanding business principles helps you make better investment decisions and spot opportunities.
Tax strategies, learning the legal ways the wealthy minimize their tax burden is essential. And foundational personal finance management, budgeting, debt management, insurance, basic estate planning. Gotta have the basics solid.
Okay, and strategy 4, network with other wealth builders.
This is about environment. Who you surround yourself with shapes your thinking enormously. Workers tend to network with other workers. They talk about job stuff, maybe office politics, commiserate.
While wealth builders network with other wealth builders.
Right. They're discussing investment deals, sharing business strategies, analyzing market trends, looking for potential partners. The conversations are different. The opportunities are different.
So the action is to actively seek out these circles. Go to investment club meetings, real estate meetups, entrepreneur groups, join online forums.
Yes. Find people who are already doing what you want to do. Find mentors. Immerse yourself in that environment, even if it feels uncomfortable at first. If you want to think like a wealth builder, spending time with them is one of the fastest ways to start absorbing that mindset and seeing those opportunities.
Now, making this shift, it's not just about learning new tactics. The source points out you also have to overcome some pretty ingrained mental hurdles, right? Obstacles tied to that worker mindset.
Definitely. These can be powerful blocks. The first one, the source flags, is the security illusion.
The idea that a steady job is the safest path.
Exactly. Many workers cling tightly to that notion of job security, believing that a regular paycheck is inherently safer than trying to build wealth through investments or starting a business.
But the source really pushes back on that. It asks, well, is that job truly secure in today's world?
That's the critical question, isn't it? Companies downsize constantly. Industries get disrupted overnight. Technology makes roles obsolete. Relying 100% on one single employer for your entire financial well-being, that's actually incredibly risky.
So the wealth builder sees it differently.
They understand that true financial security comes from having diverse income streams and owning assets that generate income independent of any one job. They trade the illusion of job security for the reality of financial independence built on a diversified foundation.
Okay, obstacle number 2, the time trap. That classic feeling, I just don't have time. I'm too busy working my job, dealing with family.
It's probably the most common excuse, right? But wealth builders, according to the source, understand that you make time for what's truly important. It often requires conscious choices and sacrifices.
Like maybe less TV or social media, waking up an hour earlier, using your lunch break differently.
Exactly. The source emphasizes that even just a few focused hours each week, consistently dedicated to learning, planning, or actively building assets, can make a monumental difference to your financial future over the long run.
It really forces you to ask, where is my time actually going? Could even 1 hour a day currently spent passively be redirected towards building my future? That's 7 hours a week right there.
It adds up fast. Obstacle number 3, the knowledge gap. That feeling of being overwhelmed, thinking investing or business is just too complicated, that you need some special degree or inside connections.
Yeah, it can feel intimidating. Finance jargon, complex strategies.
But the source offers a really important counterpoint. While yes, continuous learning is vital, the fundamentals are often much simpler than people think.
Like basic index fund investing, buying a straightforward rental property, starting a simple service business.
Exactly. These aren't necessarily rocket science.
Yep.
Many successful wealth builders started with very basic knowledge and learned incrementally as they went along. They didn't wait until they knew everything.
So the key is to just start where you are with what you know and commit to that continuous learning process. Don't let the feeling of not knowing enough paralyze you.
Precisely. And the last big obstacle, risk aversion. That deep-seated fear of losing money, of failing, of making a mistake.
Which, as we said, is kind of drilled into the worker mindset. Play it safe, avoid mistakes.
Right. But that very aversion often prevents people from taking the necessary calculated risks required to generate significant returns and build real wealth.
And the source flips the script again, saying that not taking intelligent risks is actually the riskier path long term.
Think about it. Inflation silently erodes the value of your savings if they're just sitting in cash. Job security, as we discussed, is often an illusion. Playing it too safe can mean guaranteeing you fall behind.
So wealth builders aren't reckless gamblers.
Not at all. There's a huge distinction the source makes between blind gambling, betting on outcomes you can't control or understand, and calculated risk-taking.
Which involves
Studying opportunities, understanding the potential upsides and downsides, diversifying your investments to manage potential losses, making informed decisions based on research and analysis, not just fear or greed. It's about intelligent risk, not avoiding risk altogether.
Okay, let's make this even more concrete. Can we look at some specific real-world strategies that really embody this wealth builder mindset in action, using those principles we talked about?
Absolutely. Let's start with a classic, real estate investment.
Okay. A worker usually sees real estate primarily as a personal expense, right? A place to live, a mortgage payment to make each month.
Correct. Whereas a wealth builder sees real estate potentially as an asset, a vehicle for wealth creation.
How so?
Well, investment property can generate monthly rental income, hopefully providing positive cash flow. It has the potential to appreciate in value over time, building equity. It offers significant tax advantages in many countries. And crucially, it allows for financial leverage using a mortgage.
The source tells that story of Tom, who bought a duplex instead of a single-family home.
Yeah, great example. He lived in one unit himself and rented out the other unit. The rent he collected from the tenant covered most, or maybe even all, of his mortgage payment.
So he was essentially living for free, or close to it, while someone else paid down his mortgage, and he built equity.
Pretty much. Plus, he controlled an asset worth much more than his initial down payment. Later, the source says he refinanced, pulled out some of that equity, and used it as a down payment to buy more rental properties. Now he owns several, generating significant passive income.
That strategy, living in one part of a multi-unit property and renting out the rest, is often called house hacking, right?
Exactly. It's a very practical way for people to get started in real estate investing with potentially less upfront capital than buying a purely investment property.
Okay, what about stock market investing? How does the wealth builder approach differ there?
Well, a worker might just put some money into a basic savings account, earning next to nothing. Or maybe they contribute just enough to their workplace 401k or retirement plan to get the company match, without much thought beyond that.
Which is better than nothing, but limited.
Right. A wealth builder, according to the source, develops a much more comprehensive and strategic approach to the stock market.
They're thinking about things like asset allocation, spreading their money across different types of investments, stocks, bonds, maybe alternatives.
Yes, diversifying to manage risk. They understand concepts like dollar cost averaging, investing a fixed amount regularly, whether the market is up or down, which averages out purchase price over time. They strategically use tax-advantaged accounts like IRAs or 401ks alongside regular taxable brokerage accounts.
And the key is consistency and compounding.
Absolutely. They invest consistently month after month, year after year. And crucially, they reinvest the dividends they receive, allowing those dividends to buy more shares, which then generate more dividends, maximizing that compound growth effect.
The source mentions Jane, who started young.
Yeah, she consistently invested 20% of her income into diversified low-cost index funds starting from age 22. By the time she was 50, her portfolio had grown to over $1 million. And the dividend income generated by that portfolio was enough to cover her basic living expenses. She achieved financial independence through consistent asset accumulation and the power of compounding in the stock market.
Then there's business ownership. The source often frames this as potentially the ultimate wealth-building strategy. Why is that?
Several reasons. First, it offers truly scalable income potential, unlike trading time for money. You can leverage systems, technology, and other people's efforts to grow revenue far beyond what you could generate alone.
Second, a successful business itself becomes a valuable asset. It can appreciate significantly and eventually be sold, often for a multiple of its annual profits, providing a large capital gain.
And third, business ownership often comes with tax advantages that aren't available to regular employees.
But the source is quick to point out this doesn't mean you have to invent the next Google or Facebook, right?
Not at all. Many wealth builders achieve financial independence through owning relatively simple, profitable Main Street businesses, restaurants, retail shops, service companies, skilled trades, online stores.
Like Mark and his landscaping company.
Perfect example. He saw a local need, started mowing lawns himself on weekends, built up a solid client base. Then he hired employees, bought more equipment, put systems in place for scheduling and billing.
So he transitioned from doing the work to owning the system that does the work.
Exactly. Now he owns a thriving landscaping company generating six-figure annual profits, and his role is focused on management, strategy, and business development, not pushing a mower himself. The business is an asset generating income and equity for him.
And in today's world, we also have to talk about digital assets and intellectual property.
Yeah, this is a huge and growing area for wealth building. Things like creating and selling online courses in your area of expertise.
Writing and publishing books, ebooks, audiobooks.
Developing software applications or mobile apps. Building websites that generate income through advertising or affiliate marketing. Creating digital content videos, music, designs that earns royalties or licensing fees.
The source highlights the beauty of this model, right? The leverage.
Absolutely. Often, you create the digital asset once you write the book, record the course, code the app, and then you can sell it potentially hundreds, thousands, even millions of times with very little additional cost per sale. The scalability is incredible.
Like Sarah, the marketing pro who created an online course.
Right. She spent maybe 3 months developing a course teaching small business marketing techniques. Now, that single asset generates over $50,000 a year for her in passive income from ongoing sales long after the initial creation work was done.
Okay, so those are some big strategies. But wealth building isn't just about these grand moves, is it? The source talks a lot about the importance of consistent daily habits. What are those?
Yeah, this is crucial. The source emphasizes that wealth isn't built just through occasional big wins. It's forged in the consistency of daily and weekly practices that compound over time, just like the investments themselves.
Habit number 1 seems to be financial tracking and analysis.
Wealth builders are almost obsessed with knowing their numbers. They religiously track their net worth, what they own versus what they owe. They monitor their cash flow, where money is coming from and where it's going. They keep a close eye on how their investments and assets are performing.
They're not afraid to look.
Quite the opposite. They want to look. They typically review this data regularly, often monthly, and use it to make informed decisions and adjust their strategy as needed. This is a stark contrast to many workers who might avoid looking at their financial details because it feels stressful or overwhelming.
Habit number 2, continuous learning. This came up as a strategy, but it's also a daily habit.
Definitely. It's not just something you do once. Wealth builders tend to be voracious, lifelong learners when it comes to money, investing, and business. They're constantly reading financial books and articles, following market news, studying the methods of successful investors and entrepreneurs they admire.
So it might look like listening to a relevant podcast during your commute, reading for 30 minutes before bed, dedicating some time on the weekend to analyze a potential investment.
Exactly. It's ingrained in their routine. They know the landscape is always changing, and staying informed is key to making good decisions.
Habit 3, and this sounds like a tough one for many, delayed gratification.
It can be, but it's fundamental. Wealth builders consistently make choices that prioritize long-term wealth accumulation over immediate, short-term consumption or pleasure.
What does that look like in practice?
It might mean driving an older, reliable car instead of buying the newest model, freeing up hundreds or thousands of dollars each month for investment. It could be cooking more meals at home instead of eating out frequently, saving that money for a rental property down payment. maybe taking more modest vacations for a few years to aggressively fund investment accounts.
So it's not about deprivation necessarily, but intentional spending.
Exactly. It's about being conscious of the opportunity cost. Every dollar spent on consumption today is a dollar that can't be invested to grow for tomorrow. They make deliberate choices aligned with their long-term goals.
And habit 4, network building. Again, it's a strategy, but also an ongoing habit.
Yes, because relationships need nurturing. Wealth builders actively and consistently dedicate time to building and maintaining connections with other investors, entrepreneurs, mentors, financial advisors, and other like-minded individuals.
So attending networking events regularly, scheduling coffee meetings, actively participating in mastermind groups or online communities.
Right. They understand that valuable insights, deal flow, partnerships, and motivation often come through these relationships. It's not just about what you know, but who you know and interact with regularly.
Now, it's important to be realistic. The path from worker to wealth builder isn't always going to be smooth sailing, right? The source talks about dealing with setbacks.
Absolutely critical to address, because setbacks will happen. Anyone who invests or starts a business will experience losses or failures at some point. Markets crash, investments go down temporarily, business ideas don't always pan out.
And the difference is in the response.
Hugely different. A worker deeply invested in that security mindset might panic during a market downturn. They might sell off their investments at the worst possible time, locking in losses, and then swear off investing forever because it felt too scary.
Whereas the wealth builder,
The wealth builder understands that volatility and occasional losses are simply part of the long-term investing process. They manage this risk upfront through diversification, not having all their eggs in one basket. They generally don't invest money they know they'll need in the very near term.
and they might even see downturns differently.
Often, yes. They might see significant market drops not as disasters, but as potential buying opportunities, a chance to acquire quality assets at lower prices, positioning themselves for the eventual recovery. Their long-term perspective changes how they react.
What about handling social pressure? That sounds tricky too.
It can be. As you start to shift your mindset, your spending habits, your priorities, friends and family who are still operating with a worker mindset might not understand.
They might question why you're not buying the fancy car, or why you're hoarding money instead of enjoying it now, or why you're taking the risk of investing or starting a side hustle.
Exactly. You might face skepticism, criticism, or just a lack of understanding. The source emphasizes the importance of staying focused on your own long-term vision and goals.
And maybe finding a more supportive peer group.
Sometimes that's necessary. Surrounding yourself, at least partially, with people who are on a similar path or who support your goals can make a huge difference in staying motivated and resilient against that social pressure.
And that leads to the final point here, maintaining that long-term perspective.
Because wealth building, especially relying on compounding, is inherently a long game. It takes years, often decades, for the most dramatic results to manifest. It's easy to get discouraged in the early years when progress seems slow.
So how do you stay motivated?
The source suggests several tactics: celebrating small wins along the way, hitting a savings goal, acquiring your first asset, visually tracking your progress, watching your net worth chart climb over time, even slowly at first. Keeping your specific written goals visible is a constant reminder.
And finding accountability partners.
Yeah, having someone else who knows your goals, who you check in with, who can offer encouragement when you feel like giving up, that can be incredibly powerful for sticking with it over the long haul.
So, okay, we've covered the mindsets, the principles, the strategies, the habits, the obstacles. What does this all mean when you put it together? What's the real payoff?
It means the cumulative effect, the compounding impact of adopting this mindset, applying these principles, and taking consistent action over time leads to a profoundly, dramatically different outcome.
The source uses that powerful 20-year projection example. Can you walk us through that again?
Sure. Imagine two 25-year-olds. Both start out earning, say, $50,000 a year. Person A thinks like a worker. They're a good saver, diligently putting away 10% of their income, $5,000 a year initially, into a standard savings account earning maybe 1%.
Okay. And person B?
Person B adopts the wealth builder mindset. They prioritize asset building, investing 20% of their income, $10,000 a year initially, consistently into a diversified portfolio. Let's assume it averages a conservative 7% annual return over the long term. We'll also assume both get modest 3% annual raises.
Okay, fast forward 20 years, what's the difference?
After 20 years, person A, the diligent saver, has accumulated roughly $200,000. which is commendable. Saving consistently is important.
The person B.
Person B, the wealth builder, by investing more and harnessing the power of compound growth, has accumulated approximately $550,000.
Wow, that's more than double, almost triple.
Exactly. And the crucial point is, that massive difference isn't just because they saved twice as much, though that helped. A huge chunk of it comes from the exponential power of that 7% compound growth, working on the invested assets over 2 decades. The money started making serious money on its own.
And the impact goes way beyond just the final dollar amount, right? Think about the lifestyle impact.
Oh, completely. The wealth builder, person B, now has options that person A likely doesn't have.
Like what?
Like the option to take a sabbatical or a career break without financial panic. The freedom to start a passion project or a new business without needing immediate income from it. The ability to comfortably fund their children's education or help family members. The very real possibility of retiring decades earlier than traditional retirement age.
Weathering economic storms without losing sleep.
Exactly. Having that financial cushion, those income-producing assets, provides a level of resilience and peace of mind that's hard to quantify. It allows you to pursue passions and make life choices based on desire, not just financial necessity.
And the source also mentions the legacy effect.
Right. Wealth builders often start thinking beyond their own lifetime. They're building assets not just for their own financial independence, but with the potential to pass wealth. And importantly, the knowledge and mindset that created it down to future generations.
Creating generational wealth, not just personal wealth.
Exactly. It's about providing opportunities, security, and potential head start for their children and grandchildren, allowing that compounding effect to continue across generations.
Okay, this is all incredibly motivating, but knowledge without action doesn't change anything. The final, crucial step is actually doing something. The source lays out a concrete action plan for you, the listener, to start making this transition, right?
Yes, absolutely. It breaks it down into manageable steps. Step 1, assess your current situation. You cannot chart a course without knowing your starting point.
So practically that means
Calculate your current net worth right now. List everything you own, assets, and subtract everything you owe, liabilities. Get brutally honest. Then, track your income and expenses meticulously for at least 1 month. Use an app, a spreadsheet, whatever works. You need to see exactly where your money is actually going.
and identify how much you could realistically redirect towards building assets.
Yes, and alongside that, do an honest self-assessment of your current financial knowledge. Where are the biggest gaps? What do you need to learn first?
Okay, step 2. Set specific goals.
Vague goals like get rich don't work. Wealth builders set specific, measurable, achievable, relevant, and time-bound SMART goals.
Give me some examples from the source.
Like, I will build a net worth of $100,000 by age 35, or I will generate $1,000 per month in passive income from investments within the next 5 years, or I will purchase my first rental property within the next 2 years.
And the key is to write them down and look at them regularly.
Absolutely. Make them real. Put them somewhere you'll see them often. Review them quarterly or annually to track your progress and adjust if needed.
Step 3. Create your learning plan.
Based on that knowledge gap assessment you did in step 1, make a concrete plan for how you're going to learn what you need to know.
So maybe commit to reading one specific financial book next month. Sign up for that online investing course you've been eyeing. Find and schedule attendance at a local real estate or investment meetup.
Exactly. And actively start looking for potential mentors or people whose journeys you can learn from. Make learning an intentional activity.
Step 4. Start building assets. This is where the action really happens.
Yes, no more analysis paralysis. Begin redirecting that money you identified in step 1 towards actually acquiring assets now.
So set up those automatic investments into low-cost index funds this week. Start researching potential rental properties in your target area this weekend. Brainstorm and maybe outline that side business idea tonight.
Whatever your chosen path, take the first tangible step to put money towards assets, not just consumption.
Step 5. Build your network, intentionally.
Make a specific plan. Identify 1 or 2 relevant groups online or local to join or attend this month. Reach out to one person whose financial path you admire and ask for a brief virtual coffee or advice. Make networking an active verb.
Okay, and the final step. Step 6. Track your progress.
Put systems in place to monitor how you're doing against those specific goals you set. Update your net worth calculation monthly or quarterly. Track your investment returns. Review your progress towards your passive income or asset acquisition goals regularly.
And celebrate the wins.
Definitely. Acknowledge and celebrate the milestones along the way, no matter how small they seem. hitting a savings target, buying your first share of stock, getting your first rent check. Celebrating progress is crucial for maintaining motivation over the long journey.
So, as we wrap up this deep dive, let's just circle back to the core message from these sources, the difference between thinking like a worker and thinking like a wealth builder.
Yeah.
It really isn't about innate intelligence or getting lucky or even how much money you started with.
It's fundamentally about a shift in your perspective, a conscious decision to adopt a different mindset. It's about committing to certain principles, asset accumulation, leverage, systems, compounding, and most importantly, it's about taking consistent, focused action over time.
Every single person you might look at who has built significant wealth, they started somewhere, often from very humble beginnings, and they started by making that conscious decision to see the world of money differently.
To see opportunity where others saw only risk or limitation, and to take those small, consistent steps, day after day, year after year, towards building assets and systems that work for them.
And the journey itself, this transformation from a worker mindset to a wealth builder mindset, the source suggests it's one of the most rewarding things you can do. It creates genuine options, real security that isn't dependent on any single employer. It gives you control over your time, your choices, your future.
Absolutely. And the strategies we've explored, accumulating assets, using leverage intelligently, building systems, harnessing the incredible power of compound growth, these aren't secrets reserved for some elite club. The source material makes it crystal clear. These tools and principles are available to anyone willing to learn and consistently apply them.
It reminds me of that analogy from the source. The best time to plant a tree was 20 years ago.
The second best time is today.
Right now. Your journey towards financial freedom, towards thinking and acting like a wealth builder, it starts with the decision you make today.
So we want to challenge you, our listener, take just one concrete action this week, based on everything we've discussed today. Just one thing.
Maybe it's finally opening that brokerage account you've been putting off. Maybe it's spending 1 hour researching duplexes in your area. Maybe it's just buying and starting to read one foundational book about investing or wealth building.
Whatever it is, take that first tangible step. Move from passive listening to active doing.
Because your future self, the one who has options and freedom and less financial stress, that future wealthy self will absolutely thank you for the decision you make today to stop just working for money and start making your money work for you.
Thank you so much for joining us for this deep dive.
And here's that final thought we want to leave you with, something to maybe chew on. Considering everything we've talked about, how much of your current feeling of financial safety truly relies on that potentially fragile illusion of job security? And what is one tangible step, however small, you could take today towards building a reality of genuine financial independence through owning assets?
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.